2025 has been a year where the markets and all of us have gotten used to expecting the unexpected with the backdrop of a lot of cross currents, policy-wise, interest rate-wise, economy, this tidal wave of AI washing through the market, and other challenges that are sort of popping up, imbalance with respect to geopolitics that has affected large institutional LPs, orientation around where they want to commit capital, how they want to commit capital. I think there's substantial uncertainty going into 2026, and I think we're going to have to, continue to be prepared for dealing with certain challenges that come along the way. Having said that, though, it's not so much caution, it's just a mindset of being prepared to deal with what comes along that may cause bouts of volatility that may require us to adjust. But in the backdrop of all of that, I'm generally an optimist, particularly as it relates to the U.S. economy and the drivers of growth and the drivers of innovation. I'm generally an optimist around that. And I think that 2025 has kind of demonstrated that, even with some of the challenges. We just have to be prepared to be nimble and be ready to adjust and stay very focused. And I think we'll be able to take advantage of a lot of those opportunities. Our industry has been incredibly dynamic, and it's been a fascinating opportunity to have a seat in the middle of it, because there are very few industries that have been transforming and changing with a general tailwind at the same time. The shape of the industry has really fundamentally changed. Breadth of product and breadth of capability matters a lot more today. Taking a long-term view and developing relationships with the most impactful CEOs or the most interesting entrepreneurs in the market, all of that requires some very basic capabilities which are getting harder and harder to have or to acquire, which is global reach, the capability across multiple asset classes, having large pools of capital, and having the brand and the quality of human capital to be able to position yourself to source the most interesting opportunities and then productize them or deliver them to those various constituencies in the market is now what's required. The number of firms that are able to do that across asset classes, across geographies, that are perceived as having those capabilities is shrinking. You're also seeing the models that these various firms are pursuing in terms of how they're going about building their businesses. You're also seeing that continue to diverge, in a sense, in terms of what people are trying to do, in terms of how they're structuring their business. And you've got convergences like insurance and alternative assets as one kind of pathway. You've got businesses that are trying to build bigger balance sheet businesses, and then you have businesses that are trying to continue to grow their capital base and focus on capabilities of delivering outstanding and excellent returns while maintaining a balance sheet light model. One model isn't necessarily right or wrong. I think that there are different risks associated with each of these models. And as we live through sort of these next cycles, whether it's, valuation cycle or whether it's interest rate cycles, I think that naturally you'll see the resiliency of these different models will vary. As we think about servicing some of these large pools of capital, retail is one example, insurance is another example. One of the things that's becoming more and more important now to service those channels is the question of liquidity. And so what you're starting to see happen is a bit of convergence between, think of it as private, alternative, less liquid, with public or more liquid. And I think that we're already being asked in certain situations to manage both liquid and illiquid pools of capital, to manage that liquidity dynamic. My perspective is it's harder to go from liquid public to alternative private. I think it's easier to go from alternative private to liquid. And the question is, how do firms in our industry continue to evolve to access that capability. And you can either build it yourself internally, or maybe it becomes strategic transactions, or maybe it becomes combinations of some sort. I think that where this is heading will be interesting to watch, but if you ask me sort of what's the next convergence in our world, I think the next convergence in our world is this: somewhere there's this collision between kind of liquid markets and alternative markets. And I think that's something that, we're thinking about in terms of what the future looks like. The real estate markets have probably, in a lot of respects, never been more interesting. When you look at the disruptive effect that interest rate increases have had, COVID has had on the real estate markets more broadly, there's been quite a disruption in terms of value in the real estate markets. For the first time in many, many years, you had financing rates actually invert with cap rates. So you had financing rates above cap rates. As a result of that, you've had, in some cases, a lot of assets on the real estate side get frozen into places where ultimately people want liquidity. That's generated opportunities. And we've been systematically taking advantage of those opportunities because we've had a fair amount of dry powder, and we have not been generally in a position where we've been saddled with disproportionate office exposure, et cetera, that has kind of dragged us down. So we've been able to be very offensive. I think that real estate will be one of the more interesting investing opportunities in 2026. Rates are starting to come back down. In many cases, there are some really interesting opportunities that are coming to market for sale that probably wouldn't have been had it not been for the disruption that we've seen. And it's a global phenomenon. Our opportunity in North America, in Europe, and in Asia is, I think, a really interesting one. And the investing opportunity that we're seeing, I think, in a lot of respects, is going to be sort of a next generation opportunity for us as a real estate investor. When you think about the credit markets, right, the credit markets are all about the provision of capital to companies. There's been an enormous amount of capital that has been accumulated within the industry on the private credit side. And where banks used to be the primary providers of capital and liquidity in the credit markets, that's really no longer the case. There's been a couple of $1 trillion of capital that's moved into the private credit space. So just putting that in perspective, it's become a very important part of the infrastructure of the credit markets that has happened over a relatively short period of time. When you now look at it in the context of what's happening in the market right now, where there are some issues that are popping up, the market is going through what I think is a lot of natural growing pains as the market matures, as the market evolves, and fundamentally, ultimately, we haven't been through a credit cycle since post-GFC. I don't view there to be anything sort of fundamentally broken in the market. In fact, I think if you really take a step back and you look at what's happening in the overall credit environment, I think that in many respects, what's happened is actually very positive, because if you look at the pools of capital that are funding the private credit market, generally speaking, you have longer-term locked-up capital. That's a good thing when it comes to dealing with credit cycles and dealing with distress, as opposed to banks, by the way, or depository institutions that historically have had to deal with mismatches in terms of the funding sources relative to the duration of the loans that banks were making. I think in a lot of respects, risk is more distributed than it's ever been before, which is a good thing. And again, the liability structure is probably improved overall in the market. So I think the market is here to stay. I think the market is going to continue to grow. And one thing is undeniable, which is when you look at the yield structure and the return structure in the market, if you look at what's happened to equity valuations relative to where interest rates are or where private credit returns are, there's been a compression in returns. And as a result of that, there is a ton of interest in both large institutions as well as the wealth markets. There's a ton of interest in allocating to the credit markets, and it continues. And from what I can see, it feels like that momentum is continuing, but net, I think it continues to grow as an important part of the market and an important source of capital for companies. The AI phenomenon is one of these kind of seminal periods of time in markets and in innovation, there is some pattern recognition living through these moments. One is that markets get overheated, whether we like it or not. Capital forms really quickly. Two is that usually valuation runs way ahead because of the expectation of really kind of the growth and what's going to happen. Three is that valuation generally drags a lot of things up with it. And then lastly, and most importantly maybe, is that in almost every one of these cases, the underlying technology, the innovation, is real. When you look at the amount of capital being spent and the revenue generation that has to come to support a return on that capital, there's no question that some of the capital will have been well spent and some of the capital will be flushed. And so I think, are we in a bubble? I think we are. Will there be a correction? Will there be sort of a change in sentiment at some point? There will be. That doesn't mean that technology is not real, and that doesn't mean that technology is not going to have a profound impact on a lot of the things that we think about from the perspective of investing, company structure, market structure, how AI reshapes the landscape of many of the businesses that we focus on and look at, and frankly, our daily lives. I think from our perspective, in terms of operating our business and doing what we do, we have to think of it as mainstreaming into our business. It's likely to affect a large portion of companies that operate in the market today. Some will be less impacted, some will be a lot more. But when we look at our portfolio, when we look at new investments today, it's part of every conversation. When we look at our own business in terms of powering our own business, it's critical that we pay attention to how do we affect the growth of our firm? How does AI play a role in that? That's kind of the mindset I think that you have to think about this with respect to productivity gains and how we can continue to grow and scale our business, but benefit from AI technology and the ability that technology gives us to do things at a much different level of scale, hours saved, manpower saved, et cetera. So there's a scale opportunity there for us without a doubt. And then from an investing perspective, I think, this is a generational investing opportunity. As far as the firm's growth going into 2026 and beyond, maybe the way to think about that is on two different sort of vectors. One way to think about it is, where is capital flowing from? One is on the institutional side. We have, I think, among the strongest institutional franchises in the world in our business. What I mean by that is our relationship with the largest pools of capital in the world, sovereign wealth funds, pension funds, and what we've talked about this, and our industry has talked about this, that those large pools of capital are continuing to look to do more with fewer GPs. So they're being much more selective about their partnerships. And more of the biggest pools of capital are looking to do things with us across our entire franchise. And I'm very confident that that's going to continue into 2026. When you look at the wealth markets, I think there are a limited number of firms that will ultimately be successful in that market, because you have to have the size, scale, the breadth to be able to service those markets. That's a place where our reputation for being focused investors and delivering quality returns and really worrying about our stakeholders, that's a place where that is paying off. The market has, I think, come to appreciate that TPG has demonstrated its ability to grow across two different sources of growth, which is organic growth and incubating new strategies and incubating new businesses, which, by the way, from my perspective, is very much a developed skill in terms of how you do that. And then secondly is on the willingness and the ability to make acquisitions. And in the human capital business that we're in, acquiring businesses is not an easy thing to do. And we have, I think, demonstrated to the market that we can do it, and we can do it very successfully. When you think about those two pathways to growth, I think that our expectation is that we will be driving growth through both of those pathways. I think everybody is very proud of what TPG has accomplished, what we built together. The key for us is providing something and creating opportunities for our partners where we are providing something different. We've got a unique angle in terms of how we do what we do. We've got a unique culture in terms of how we engage with our stakeholders. And that has driven our success. We're in an incredibly privileged position, and we're going to continue to build on it.